On June 18, 2020, the auditors at Ernst & Young declined to issue an opinion on Wirecard AG's consolidated financial statements for the 2019 fiscal year. The stated reason was specific. Approximately $1.9 billion held in trust accounts, they wrote, in all likelihood, do not exist. Two banks in the Philippines, named as custodians of the funds, confirmed that they had never held the money and that documents bearing their letterhead were spurious. Within a week, a company that had displaced Commerzbank in the DAX 30 index filed for insolvency. The structural question is this: how does a balance of $1.9 billion in cash, the single most verifiable asset class on any balance sheet, survive a decade of audits before anyone confirms whether it is there? The instrument at the center of Wirecard's collapse was the Escrow trust account, operated through what the company called its third-party acquiring business. Begin with the legitimate structure. Wirecard was a payment processor. When a consumer paid a merchant with a card, Wirecard sat in the middle, routing the transaction and taking a fee. To process card payments in jurisdictions where it did not itself hold the necessary licenses, Wirecard used local partner companies. These were the third-party acquirers. They held the regulatory permissions. Wirecard held the technology and the customer relationships. The TPAs processed transactions on Wirecard's behalf and remitted the proceeds. Because these transactions carried settlement risk and chargeback obligations, the proceeds were parked in escrow trust accounts. A trustee held the cash on behalf of Wirecard until obligations cleared. This is an ordinary arrangement. Escrow exists precisely so that funds are ring-fenced from the operating entity and controlled by an independent party. The critical accounting consequence: cash held in these trust accounts was consolidated onto Wirecard's balance sheet as cash and cash equivalents. Trust balances are treated as the company's own liquid assets because the beneficial owner is Wirecard, even though the legal custodian is the trustee. By 2018 and 2019, this third-party acquiring business had become the reported engine of Wirecard's profitability. The escrow balances associated with it grew to represent roughly a quarter of the group's total assets. The structural vulnerability follows directly. The most important cash on the balance sheet was cash that Wirecard itself never touched, held by trustees Wirecard selected, in jurisdictions distant from its auditors, verified through documents the trustees supplied. Follow the architecture step by step because the design is the point. Step 1. The TPA business was concentrated in a small number of partner firms operating in Asia. Chief among them, according to the special investigation later commissioned by Wirecard's own supervisory board and conducted by KPMG, were entities processing payments in Singapore, Dubai, and the Philippines. The reported revenue and margin from these partners was disproportionate to their apparent scale. Step 2. The proceeds from these partners flowed into escrow accounts controlled by a trustee. Between 2015 and 2019, the arrangement shifted between trustees. The balances held in these accounts rose to approximately $1 billion by the end of 2018 and to $1.9 billion by the end of 2019. The figure EY would ultimately refuse to confirm. Step 3. Verification of these balances depended on a documentary chain that never touched an actual bank in a form the auditor independently controlled. Confirmation of the trust balances came through the trustee. The trustee, in turn, presented documents purporting to originate from the custodian banks, BDO Unibank and the Bank of the Philippine Islands. When the collapse came, Both banks stated that they had no relationship with Wirecard and that the documents were forgeries. The president of one of the banks described the documents circulating in Wirecard's name as fabricated. Step 4. The KPMG special investigation, published on April 28, 2020, could not verify the majority of the profits generated by the third-party acquiring business for the years 2016 through 2018. KPMG reported that it was not provided with sufficient documentation to confirm the existence of the revenues, and that for large portions of the period, the underlying transaction data was either missing or supplied only through the partner firms themselves. KPMG could neither confirm nor refute that the revenues existed. In forensic terms, that is not a clean finding. An asset that cannot be confirmed to exist, whose supporting documentation flows entirely through the counterparty that benefits from its existence, is an asset with no independent anchor. The structural core is now visible. Every point at which the $1.9 billion could have been checked ran through a party with an interest in the balance appearing real. The trustee reported to Wirecard. The custodian confirmations were supplied through the trustee. The transaction data came from the partners. There was no leg of the verification chain that Wirecard did not effectively originate. Cash, the asset a listener would assume is the hardest to fake, became the easiest precisely because its verification had been routed offshore through a trustee into two banks that turned out never to have held it, which raises the detection question. This structure was audited by EY for roughly a decade. How did the confirmation process fail for so long? The answer lies in how audit confirmations of cash are meant to work versus how they were performed here. The standard procedure for verifying a cash balance is direct confirmation. The auditor sends a request to the bank, and the bank replies directly to the auditor without the client as intermediary. The independence of that channel is the entire point. If the client, or a party controlled by the client, sits between the auditor and the bank, the control is defeated. The record establishes that for years, the confirmations of the trust balances were not obtained directly from the custodian banks. They were obtained through the trustee, and in some instances through documentation that the auditor did not independently source from the banks themselves. EY has since faced extensive regulatory scrutiny in Germany over the adequacy of these procedures. The German audit oversight body found deficiencies in the audit work. The essential failure is a control substitution, a third-party confirmation that passed through the very parties whose numbers were being tested was accepted in place of an independent one. There is a second layer to the detection failure, and it is not about the auditor. It is about what happened to those who raised the alarm from outside. Beginning in 2015, the Financial Times published a series of reports questioning Wirecard's accounting, and in early 2019 published specific allegations concerning the Asian operations and document forgery. The response was not correction, but counterattack. BaFin, the German financial regulator, opened an investigation not primarily into Wirecard, but into potential market manipulation by short sellers and journalists. In February 2019, BaFin imposed a 2-month ban on new short positions in Wirecard shares, a measure typically reserved for systemic institutions. The regulator treated the reporting of the fraud as the threat, and the company as the party to be protected. For detection to have occurred earlier, one thing had to be true. Someone in the verification chain had to insist on contacting the custodian banks directly, outside the documentary channel the company controlled. That did not happen until 2020. When EY finally attempted to obtain confirmations directly from BDO Unibank and the Bank of the Philippine Islands, the banks answered that there was nothing to confirm. The unraveling followed once that direct channel was opened. The sequence was compressed. The KPMG special report on April 28, 2020 signaled to the market that the profits of the core business could not be independently verified. This was the first crack because it came from an investigator the company itself had hired to clear its name. Over the following weeks, EY pressed for direct bank confirmation of the $1.9 billion in trust balances ahead of the delayed 2019 annual report. On June 18, 2020, EY delivered the finding that the balances in all likelihood did not exist and refused to issue an audit opinion. Wirecard announced the missing $1.9 billion the same day. The share price fell more than 60% within hours. On June 19th, the company's chief executive resigned. On June 22nd, Wirecard issued a statement acknowledging that the $1.9 billion, with a prevailing likelihood, did not exist, and withdrew its prior financial results for 2019 and the preceding years, stating they could no longer be relied upon. On June 25, 2020, Wirecard AG filed for insolvency, citing impending insolvency and over-indebtedness. The US dimension is documented in the SEC's enforcement record. On May 12, 2023, the Securities and Exchange Commission filed a settled action against Wirecard's former chief executive. The SEC's complaint stated that Wirecard reported the existence of hundreds of millions of euros in cash held in trustee accounts that did not exist, and that the company overstated its revenue, cash, and customer numbers. The complaint framed the escrow trust structure as the vehicle through which fictitious revenue from the third-party acquiring business was made to appear as genuine cash on hand. The former executive settled without admitting or denying the allegations and consented to relief, including an officer and director bar. What the Wirecard case establishes about the mechanism is narrow and precise. Escrow and trust structures shift the physical control of an asset away from the reporting entity by design. That is their legitimate function, but the same feature that makes them useful for ring-fencing risk also relocates the point of verification. When the confirmation of a trust balance is permitted to travel through the trustee or through documents the client's counterparties supply, the auditor has not verified cash. The auditor has verified a representation about cash. The direct regulatory consequence in Germany was structural. In 2021, the government enacted the Financial Market Integrity Strengthening Act. It dissolved the existing two-tier system of financial reporting enforcement and transferred primary authority to BaFin, expanding the regulator's powers to conduct forensic examinations and to order direct information from audited companies. Mandatory audit firm rotation requirements for public interest entities were tightened. And the case became a standing reference in audit standards discussions on when third-party confirmations of cash require an independent channel to the holding institution. The finding is that a $1.9 billion cash balance failed not because cash is hard to verify, but because the chain of verification had been permitted to close in on itself.